So Telus earnings are out. Is it the time for Telus to cut their dividend? Disclaimer, the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. And I must say, I'm still frozen because we're still in the winter. I'm still running in the morning. I still hate winter, but I'm not the only one frozen. Telus dividend is still frozen as well. So this is what we're going to talk. I know you didn't saw this one coming, Vero, right? But I wanted to make a long detour to bring the fact and remind people, unfortunately, yeah, Telus earnings are out, but there's no news about the dividend, and I don't expect any positive news coming up either. So how are you doing on your side?
I'm good, but I was really wondering where you were going with that, but now I get it. And yes,
especially that today is not that freezing actually at the time that we record, so it's not even an excuse. But anyways.
Well, for you guys, just so you know, we record this on February 12th, and it's really like Telus release its earning today. So first, thank you, Mike, for taking the time to review the report so quickly. And now you know that Telus is struggling. You know there's a pause in its dividend growth. But what investors want to know is, is it a buy? Are there tangible reasons to wait for a recovery for those who already hold it? And this is what we will answer today.
And it's a very valid question, actually. And there might be a great opportunity. I mean, mind you, there is a scenario where Telus is pulling out what I called an Enbridge, because that's what, I mean, completely different situation, different industry. So don't try to make a parallel between Telus and Enbridge. But what I want to say by that is Enbridge in 22, when interest rate rose, they were a bit tighter with their cash flow. There was a lot of negative sentiment around the company, and they kept on moving forward. And eventually the stock price fully recovered and even better than that. So it had like a great 25 and start of the year in 26 as well. So just to illustrate that nothing is necessarily lost, but we need to get down to our investment thesis and to get some rules. So ironically, I sold my shares in December, but I am really cutthroat when it comes down to follow my rules. So one of them is I focus on dividend growers. I was fine with having Telus in my portfolio as long as two things would happen. A, cash flow metrics would improve, which is still the case to this date. And B, they would maintain like a minimal dividend increases. So at 3%, I was happy. So I think it was like around March or April of 25, they came with their dividend growth policy for 25, 26, 27, 28. And they said, we are going to maintain a dividend growth policy between 3 to 8%. So 8%, I was like, okay, man, like, let's not talk about unicorns here and rainbows. You're pushing it. But 3%, I can deal with that. High yield, matching the inflation, match my description of a deluxe bond, that would have been more than enough. But then twist of event, they changed their mind, froze the dividend later in the year. And this is where I decided to get rid of my shares. However, it's of course not necessarily what you should be doing. So we're going to do a deep dive today, special report type of thing on Telus to know what is going on here.
And just before we start, remember not to consider this episode as a buy or a sell recommendation. You must always do your due diligence before buying or selling any securities. Mike.
Yeah, I'm changing. I'm shape-shifting now. There you go.
I think it's the first time it ever happens to me. So let's start with a big overview of the company. Mike, please quickly describe its business model. Like we all know that Telus is a telecom, but it's also more than that, right?
Yeah, and it's going to help you also read the quarterly earnings or the annual statements, because Telus has divided its business into different business segments. The first one is T-Tech, which is really the wireless and wireline segment. So that's the biggest one. That's the most clear because, I mean, we all know that Telus is as close as a pure play on wireless than other big telcos, such as like BC and Rogers have like a big part in media, which Telus doesn't have. They
Mhm.
have small growth segments. I mean, expected growth, and that was part of my investment thesis for several years. It was quite promising. Today, it's kind of like a big hit and miss. So we have Telus Agriculture that never found a way to like establish themselves as a leader and start growing. So even this quarter, we're going to talk about it later, but the revenue were down once again. So yes, they're trying to use technology to help farmers, but it's not that big yet. We have Telus Healthcare that has grown through several acquisitions, and this one, I would say it's quite a success now. It's becoming something interesting, but I mean, it's still about 1/10 of T-Tech revenue. So we're not talking about big things. So on a quarterly basis, imagine like roughly $5 billion in revenue from T-Tech, and then you have about $500 million from Telus Health. So even if Telus Health would be up 25%, it would be nice, but it's
Mhm.
still not enough to move the needle.
Right.
And then you have Telus Digital that used to be Telus International with an infamous spinoff. I mean, they actually did a pretty good job from the Telus perspective because they spun off Telus Digital, used about $500 million to pay down debts, and then they bought back Telus International after it crashed and burns on the market at a very cheap price to bring it back private. So, I mean, definitely a lot of investors were not happy about it, especially those
Right.
that bought into Telus International. But from Telus, in terms of move, I mean, kind of like a Brookfield move because Brookfield is known to do those kind of things. So it was not a bad thing. But long story short, I mean, if the stock, when Telus International was public, when the stock crashed, it's not necessarily because it's a great business. So it's
Mhm.
relatively flat these days. And yes, they got it at a good price. So maybe it's going to eventually become a growth story. But as you can see, we're having a lot of what ifs and possible and potential, not so much something that is concrete and growing today.
All right, so let's move to the investment thesis. How would you describe the reasons to invest in it, looking at its playbook, growth vectors that you kind of already touched on, and economic mode?
Well, I mean, Telus playbook, relatively easy. It's literally based on its cash cow business of you have customers, they have wireless, wireline, or they have cable or internet services with you. So recurring services, subscription, making a bunch of money with that, a lot of cash flow coming in. And now you're trying to use that cash flow to find growth aside through what I said, Telus Agriculture, Telus Healthcare, International, trying to, and this is what I really liked about Telus at one point is they kind of like transformed themselves to become almost a technology company. So using
Mm.
technology, using now the growth of AI to fuel other business segments. So I found that quite seductive back then. Of course, debt was cheap and it was during the good days where the revenue, the earnings, and the dividend was growing rapidly. I keep saying, you have to review each of your position quarterly and make decisions about your investment yearly because environment changes, business model changes, and this is what's happening with Telus right now. So it
Mhm.
used to be a great cash cow with a lot of potential. Now it's getting a little bit tougher.
So we have seen the darker side for many quarters. Let's dig into them for a bit. What are TELUS business vulnerabilities, industry and market threats, and competitive landscape, which could be regrouped in the potential risk section?
Yeah. So business vulnerabilities, I see like two right now. The first one, obviously, a lot of debt on their balance sheet. So it put
Mhm.
pressure across the financials, interest charges that are higher. And of course, the fact that they're dripping their dividends. So instead of like paying dividends in cash, they issue more shares through a drip. They give a discount. We're going to talk about it later on today. But all of that to say the first thing is the balance sheet is under a lot of pressure. And the second thing, which is not that great, is revenue doesn't grow. It's really, really hard right now. And we saw that for Bell, we saw that for Rogers. It's tough to find steady revenue growth among those. And if you have a balance sheet under pressure and you struggle to grow your revenue, it's kind of like it doesn't smell good. On top of that, you have market threats, which is like the biggest one is the fact that the government wants more competition. So they facilitate, for example, the purchase of Quebecors when they wanted to acquire Freedom Mobile in the Rogers Shaw merger. The government just wants to have like more players offering wireless
Mm,
services. So if you're struggling to grow and on top of that, you enter more competitors, I mean, it's not going to help you. And finally, I mean, it's capital intensive. We all know that. So CapEx has been a great focus for several years. So a lot of like bad things happening at the same time for Telus. It's like in 24 and 25, I compared Telus and Bell, and my conclusion was always the same. It's tough, but Telus doing better. It's tough, but it's
mhm.
better. And then the cash flow is getting better and everything. So I thought they might be able to turn that corner and eventually thrive. I'm not saying it's not going to happen yet, but the dividend freeze kind of like literally cool off my optimism.
Right. Mike, I just wanted to add maybe not a question, more of a comment. I was listening to the description of those risks and I was like, he's almost describing a utility stock. Like, I know it's in the communication services sector, but it probably should be changed somewhere.
You are right. And if you look at ETFs that focus on utility investments, sometimes they will add pipelines and telcos in their mix because they have like similar structure in a sense that it's capital intensive, it's recurring revenue, usually relatively stable in terms of like what you can predict in terms of cash flow and what's going to come up, limited growth vectors. So there are a lot of things that are alike. So when you see that if you have like a lot of pipelines, a lot of telcos, and a lot of utilities in your portfolio, it's not really diversification in the sense that you're going to get affected by interest rates, you're going to get
Mm,
affected by a recession. So those are the things that are going to wait a little bit on your portfolio. It's going to also not be the biggest growth vectors of your portfolio either. I mean, right now, utilities is benefiting from the hype about investment into AI and the need for more power. But again, that is yet to be developed. But overall, they're not known to be super powered stocks. They're just
mhm.
there to stabilize your portfolio.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
All right, so we can't continue without looking into what happened on December 3rd, 2025. That day, the company announced a pause in its dividend growth policy. What's the plan behind this decision?
Yeah. So before we go to the real plan, I thought of like making an analogy and talking about our good friend Joe. Joe is being Telus, of course. So Joe, look at his personal finance, and it's a little messy. He has like a big mortgage. He spends a lot, sometimes more than his salary. His children allocations are a concern because he loves his children and he keeps on giving so much money to them every week. Kind of crazy a little bit. So then he's still a responsible parent. He acknowledged the situation and decides to sell a few things on marketplace. I mean, it's always a good way to deliver a little bit. So you sell a few things that you don't need anymore or you don't use that much, and you use the money to pay off a little bit of your debt and your mortgage. So that's interesting. And then his wife saying, Joe, we're still not in the best financial situation ever. And he's like, yeah, but let's calm down a little bit. I mean, we spent a lot on home renovations, but they're almost complete. So less money is going to come out of the bank account now. We should have a better hand on our budget going forward because the big
Mhm.
spending is over. And then his wife keeps on asking, it's like, yeah, but kids allocation is still a problem. You're paying them a lot. And on top of that, you don't even put them all the money into their bank account, but you have to trade for services like driving them to hockey practices and so on. So you keep on like just postponing problems going forward. It's kind of like IOU type of things. So eventually he comes out to his senses and he already warns his beloved children like, you know what, those services are going to stop and it's just going to be the allocation in cash probably in 27. So we have to stop like doing all those services because I mean, it's piling up. It's way too big. So the next 2 years for our good friend Joe, he's kind of still have a plan, still on marketplace, still trying to manage his budget, still not trying to spend too much. That's the goal, right? He wants to do some side gigs on the side on top of that to improve his income. So doing the right things, right? So lowering your budget, increasing your income, pretty much basic personal finance 101. But you need to go through those next 2 years without any hurdles. Because I mean, if he's not able to do overtimes or if his side gigs are not working at well, then he's going to have like some kind of problem. So Joe's not dumb. Joe is a good guy. He's trying to be responsible, but it's cunning to catch up to him. And what's happening on December 3rd is like twist of event. He's like, you know what, kids, we're not going to grow the children allocation anymore. I cannot increase it. So yes, he does have a plan, but now you kind of have like cracks in that plan's happening. So now off with Joe, going back to Telus with numbers. The real plan, kind of like exactly how I laid it out. So they expect to grow their free cash flow with growth coming from Telus Digital, Elf, and T-Tech, Telus Technology, that is the main business. At the same time, they also said that their massive investment in developing 5G and other CapEx should go down. So that will also boost free cash flow. They expect to have additional free cash flow because what they did is that they sold some of their assets. So recently last year, they sold 49% of their stake in their cell towers and used that money to pay down debts. So if you pay down your debts, you pay less interest charges, you have less pressure on your balance sheet, you have a little bit more cash flow. So it's kind of like getting into the right way. And of course, they claim, and they are well aware of that, they have been issuing 18% more shares in the past 5 years. So they said, you know what? No more drip discount starting in 2027 because they have to stop issuing shares to pay those dividends. It's just like postponing a problem that is growing and a little bit out of control. The last step of that plan, and of course, management always comes saying, yeah, it's to get more financial flexibility and we're going to get more cash flow. It's going to be better. They even say that when they cut the dividend. This time it's just a dividend growth pause. It's less damageable than a dividend cut. But now the question remains, are we going to get a dividend cut eventually? Because there are a lot of things, a lot of unknown in this plan that may be going to end up saying, you know what, well, our Telus, healthcare, or digital, or even T-Tech is not growing, so cash flow is not increasing, and that could become a problem. It makes sense, but there are a few places where it could go wrong.
Right. Just to make things as clear as possible, back in December, how bad was Telus debt burden?
I mean, it was getting better. So everything is like bad, but getting better. So roughly $26 billion. The net debt to EBITDA ratio had improved to 3.5 times. Of course, the long-term objective is 2.5. So we're still a long way to that. Management said that they expect to reach 3 times, so net debt to EBITDA by the end of 2027. So you can see that there's a clear plan toward 2027. And on top of like trying to improve their revenue and reduce their CapEx, they also expect to sell more assets. So that monetization, again, another Brookfield move where you sell your assets when they are worth a lot, when it's the right time. So you can use that money. I mean, Brookfield is reinvesting this. So it's asset recycling. In this case, it's like really monetizing because you sell, you take the money, and then you pay down debts. The one thing I love about this plan as opposed to BCE is this is exactly what BCE told us they would do when they announced the sell of their stake of MLSC to Rogers. And they quickly turned around and bought Sibley Fibers. So instead of doing this, Telus is not saying, oh yeah, we made more acquisition and we're investing massively in Telus Health or Telus Digital. They actually used that 1 point something billion, I think it was 1.2 if I remember correctly, and pay down debts with it. So at least they're doing what they're supposed to. So I was upset with the improvisation about the dividend growth policy, but for the rest of the plan, they are following it.
Okay, but Mike, let's discuss this drip plan a bit more. Like you've said, Telus is using drip to keep the dividend alive while it pays its debt. Does that make sense to you, or is it just like a risk for bigger dividend cut in a near future? Like, in other words, what are the main risks associated with this plan?
So when you are tight with your budget and you literally spend more, including the dividend and what you can generate, it's always a problem. But on the other side, we see that quite often with capital intensive businesses where temporary, the company will borrow money, they will get into more debt to finance both their projects, their maintenance, and pay the dividend. Another way to finance the operation is, of course, by issuing more shares, which eventually, though, it's not sustainable, right? So you can do that for a specific amount of time if you believe, and that was the message for several years, that they will increase their cash flow from operation, increase their free cash flow, and generate a lot more money. So it's like our good friend Joe saying, you know what, Vero, don't worry about anything. We spent a lot of money on the house, but the plan is to sell it in 2 years, and then we're going to recover not just the money that we put in renovation, but a lot more. So
Right.
now you get to that point where you're not like generating that much. And this is what hurts in this plan. As I said, in the past 5 years, shares count has increased by 18%. So that's a problem. They were aware of it. And this is why now they're trying to cut the discount they give into DRIP. So either they would just give shares instead of dividend, but at least will not be with a discount, and eventually completely cancel this program and just pay in cash. But they knew that during the growth phase, their capital intensive phase, they could not do both. So this is why they made that choice. So, I mean, of course, when you look at it today, it doesn't look that great. But if Telus was able to grow their revenue by like 5 to 10% per year over the past 3 years with double-digit cash flow growth, we would all say that they're geniuses. So sometimes you come up with a plan not exactly happening how you thought it would, and this is where you look like a stupid CEO. But eventually, I mean, it could have turned out the other way around as well.
So now that we have set the table, let's see what Telus had in its book for Q4 2025. So how is the revenue looking, Mike?
Not good. Not good, unfortunately. I mean, not catastrophic, but again, still in the same problem that we mentioned before. Revenue was down 2% year over year. So not good news here. We have T-Tech that was down 4 or 5%. So the main business not doing that well. On the good side, we have Telus Health that was up 13%. But as I mentioned, since it's a smaller part of the business, it's great. It's positive, mostly fueled by acquisition. So it's one thing, it's great, but eventually you need organic growth as well. Telus Digital was up about 3%. But on this case, it was just because they made a lot of money in Europe. So they got paid in euro, and the euro grew in value versus the CAD. So just favorable currency exchange. Again, not something quite organic or repetitive. So not exactly what you're looking for. And Telus Agriculture, I mean, the revenue were down like $9 million versus last year. It's still very small. But even on top of the fact that it's small, it's not going anywhere. So not overly good news in this place.
And what about its earnings per share?
EPS, actually, it was worse. It was down double digits. So again, not good news. What is more important, I would say, is to look at the cash flow metrics instead. So yes, the earnings were down 20%. You may freak out a little bit, but you have a lot of amortization. You have a lot of like non-cash adjustments. So for capital intensive businesses, I prefer to look at operating cash flow from operation, free cash flow, and CapEx. So in that regard, we have operating cash flow that was up 5%, free cash flow that was up 7%. So again, as I told you, last year in 25, the entire year, those metrics were getting better. So this is what I kind of liked and tolerate Telus in my portfolio for that reason. But the CapEx also grew this time to $649 million, an increase of 18% versus last year. So we had some acquisition as well in there. I mean, it was okay news in terms of like cash flow metrics because you have at least 2 out of 3 that is positive. I mean, the three of them grew, but you don't want to see it growing up. So that helped a bit, but definitely not an amazing quarter, if I can describe it this way.
Okay, so now what would you say to investors who currently have Telus shares in their portfolio?
What's important at this point is two things. Go back to your investment thesis. That's the first, to see what was the reason why you wanted to have Telus in your portfolio in the first place. And I'm going to give you my rationale and why I sold, actually. So first, my investment thesis was, okay, so this company is very well established in Canada. Strong competitors, but everyone has a piece of the pie. They generate a lot of cash flow. They use that cash flow to generate other business segment that should drive more growth. So agriculture, healthcare, and international/AI. So I thought that is an interesting play here where you can combine steady cash flow and growth on the side. That was my investment thesis. When I came back to that, I was like, yeah, not exactly what's happening. So I don't really like it. And if you look for 2026, Telus issued their guidance. They expect revenue to increase 2 to 4%. So I mean, it's okay, but not flabbergasting. They
Right.
expect that capex should decline by 10% to 2.3 billion, and free cash flow should increase by 10% to 2.45. So those are kind of like the good news. Again, like I said, the next 2 years, like 26 and 27, will be critical for shareholders, for Telus, and also for the sake of the dividend, right? So that was like the first part. So on the first part, investment thesis, a bit shaky here, not super confident. But then you look at the numbers, which are even more important in my opinion. If you don't focus on dividend growth, then it becomes, do I trust management plan enough that it's going to turn around the corner, not cut their dividend and moving forward?
Mm-hmm.
If you focus on dividend growth stocks like I do, well, then it becomes a no-brainer to get rid of it and move on. I'm not telling you it's going to go down, the stock price is going to go down, or the dividend is going to get cut. My point is, the most important metric in my portfolio is how much the dividend is increasing year after year. So in an ideal world, I only want to have companies growing their dividend by at least 5% per year. So at zero, we're quite far. And actually, I sold Enbridge when in 22, and I made a lot of profit on it, so I'm super happy. But the thesis was the same. The company, when I bought it back in 2017, used to increase its dividend by 10% a year. It dropped to 3. Not really exactly what I'm looking for. So I did not say Enbridge is the worst company ever you should run, but I was like, yeah, that doesn't fit with my strategy. So I'm just going to get rid of it and then move on. On that one, I made money. On Telus, I made a little bit of money because I owned it for a long while, but I mean, definitely not my best performer. I'm not going to confuse Telus and Visa or Microsoft in my portfolio, for example, definitely. So long story short, instead of trying to base your investment decision of buy, hold, or sell on hope and say, oh, I hope that it's going to happen. And actually, it's kind of funny because if you didn't like the last CEO, good news, he's stepping down, he's retiring. And I saw that on Twitter. I did not have the time to make the research, but I saw that the new CEO, Victor Dodig, used to be CEO at CIBC. So you might want to dig into that part as well. But the point is, do you believe in this plan? And then every quarter, make sure that you keep track on their guidance. So is the revenue will increase in 26? How's the capex is going to go, and how's the cash flow metrics are going to go? Because if cash flow doesn't increase by 10% and capex remains stable, eventually it's not going to work. It's just math, like sometimes it's kind of funny because I'm diverging on another topic, but I was discussing with a potential partner about an investment, and then he got really excited about a project, and I'm like, yeah, but the math are not working. So I don't really care about what you hope and what you think and what you heard. The math are not, and you cannot twist numbers at one point.
Right.
I mean, if the math are not mathing, well, there you go. You have your answer. And sometimes it's best to let it go. That's what I would tell all shareholders or investors thinking about Telus, just making clear rules about your decision. And if you're on the line and you don't know what you're going to make in terms of decision, don't hold for holding it in the hope that it's going to go back to, I don't know, like, oh, if it's going back to $23, I'm selling. Now you're giving away all the power to Mr. Stock Market, and God knows where it's going to go, right? So you might as well focus on say, you know what? I want that cash flow metrics to go up by 10% every quarter. And if it's not happening, I'm going to sell my share. and I give Telus a year to prove me that they're on the right path. I give them 6 months. I give them a year and a half. I don't care. Put something that is tangible and measurable. Because if you're just saying, "Oh, I'm going to wait and see," well, that's not an investing
See
strategy,
what?
right? Wait and see. Yeah. Well, there you go. I mean, if you want to lose weight and you just want to wait and see, well, probably that's not going to work very well. If you want a promotion and you're just going to wait and see, chances are you're not going to get that raise either. So, I mean, it's like this in life. I mean, if you want to, we just passed Valentine's Day. If you want a girlfriend or boyfriend, like a spouse, but you just wait and see, well, probably you're going to wait for a while.
All right. Nobody's going to appear in your living room by luck. Right?
If it does, I mean, ask yourself some serious question about what you're drinking.
Right. Well, Mike, that was an awesome deep dive. It's been a long time that we did one like this. So thank you for enlightening us. And, listeners, talking about like debt and struggling company, we will look into stocks with dangerous cash flow trends next week. So hit the subscribe button underneath our podcast logo not to miss it. And if you'd like more stock ideas like reliable ones, download the Dividend Rockstar list free at thedividendguyblog.com/rockstar. This list includes the dividend triangle matrix to help you start your research on the right foot. And until next time, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.